Before the clock strikes midnight on December 31st, there are some tax planning opportunities you may want to take advantage of. Now, these tax planning tips could save you hundreds, if not thousands of dollars on your next tax return. These tax planning strategies are easy to overlook, but incredibly valuable. So in this video, I'm going to break down the top tax planning strategies that every Canadian needs to be considering before the end of the year. I'm also going to go over two bonus strategies at the end of the video that you maybe hadn't even thought about. My name is Owen. I'm an advice-only financial planner, a CFP, and I'm the founder of Advice. Advice is an easy and powerful retirement planning platform that you can use for just $9 a month or $49 for the year. Now, the first strategy I want to highlight is strategic RRSP and RRIF withdrawals. If you've had a low income year, if you're early retirement, if you've had a low income year before retirement, we want to think about topping up your income using a strategic RRSP or RRIF withdrawal, and we want to top up your income to the top of that tax bracket. Ideally, we want to fill up those first or second tax bracket, especially in early retirement. So I'll give you an example. Imagine we had CPP and OAS income. Imagine we had $12,000 a year in CPP, $8,000 a year in old age security. Imagine we had $5,000 a year in interest income. Our total taxable income for the year would only be $25,000. But if the top of the tax bracket, just as an example, if the top of the tax bracket was $55,000, the lowest tax bracket, we could make a strategic RRSP RRIF withdrawal of $30,000, taking advantage of that lower tax bracket in early retirement. So if you've had a low income year, you want to think about a strategic RRSP or RRIF withdrawal. Now, the second way you can think about this is if you are going to receive GIS in the future. In that case, drawing down your RRSP before the age of 64 can be a strategic advantage. We did a whole video on GIS planning. I'd recommend taking a look at that one. In the example here, imagine you had $60,000 in salary income for the year. The taxable income that you would have for this year is $60,000. Maybe the top of the next tax bracket is $90,000. We can make a strategic RRSP RRIF withdrawal of $30,000. Now you might be thinking, oh, and why would we do that if we're still employed, if we're still in a higher tax bracket? The reason is if we're going to be getting GIS benefits in the future, if we're going to be eligible for GIS, the effective tax rate for anybody receiving GIS is anywhere from 50 to 75%. So by drawing down the RRSP RRIF before the age of 64, we can avoid some of those high marginal effective tax rates when eligible for guaranteed income supplement. Now again, there's a whole video on how to plan around GIS, the 8-year GIS strategy. We recommend taking a look at that. Now the next strategy I want to highlight for you is capital loss harvesting. So if you have non-registered investments and if they're in a loss position, you may want to think about crystallizing that loss. You may want to sell those investments at a loss, which can be used to offset current or future capital gains. You can actually carry those losses backwards up to 3 years. So if you've had capital gains in the past, you can trigger a capital loss this year and carry that back on your prior tax returns. You can also carry that capital loss forward. If you haven't had any capital gains, if you don't have any capital gains this year, you can still crystallize that loss and then carry that loss forward. Now watch out for superficial loss rules. So if you are going to do this, make sure you read into what a superficial loss is and make sure you don't trigger the superficial loss rules when harvesting your capital losses. Now, a similar strategy is capital gains smoothing. So if you have some non-registered investments, if they're in a capital gain position and you have a low income year this year, you may consider crystallizing some of those capital gains so that you can report them on this year's tax return. So you might again choose to fill up to a certain tax bracket by strategically triggering some of those capital gains in a non-registered account. This really helps you avoid lumpy or large gains in future years when you have to sell those investments either in retirement to create retirement income or because you need to rebalance your non-registered portfolio. So think about crystallizing some of those gains, doing some capital gains smoothing, especially if you've had a low income year. Now, if you have a RRIF or a LIF, you have to take out at least the minimum by the end of the year. So if you have a RRIF or LIF, a registered retirement income fund, a life income fund, you have to take out at least the minimum by December 31st. You can obviously take out more. That's always an option. Could be part of those strategic RRSP WIF withdrawals we just talked about. But you need to take out at least the minimum by the end of the year. So double check, make sure you've taken out the minimum from the RRIF and LIF accounts for the year. The next strategy is to use up the pension income tax credit. So if you're over the age of 65 and you don't have any pension income could be from a defined benefit pension, but also if you're over the age of 65, it could be RRIF or LIF withdrawals as well. So if you are over the age of 65, or if you've just turned 65 this year and you don't have any pension income, you may want to consider a partial RRIF conversion for $2,000. When you withdraw that $2,000 from your RRIF, you become eligible for that pension income tax credit. Now you have to make that withdrawal by December 31st of this year, and it has to come from a RRIF or LIF account, and you have to be over the age of 65. But you can then take advantage of that pension income tax credit. Now, the next opportunity is charitable donations. If you already had these in your plan, you might want to do it by December 31st. If you make those charitable contributions, those donations by December 31st, you can claim the tax credit on your current year's tax return. Now, the other benefit here is you can combine them within a household. So over the first $200, you get a 29% federal tax credit. So you want to make sure if you're planning donations, pull it forward, make sure you do it by December 31st so that you get the biggest bang for those donation dollars that you're giving. Now, the first of the two bonus strategies is one around TFSA withdrawals. If you are already planning to take out money from your TFSA, maybe in early next year, you may want to consider doing that by December 31st. The reason why you'd want to do that is when you make the withdrawal by December 31st, that amount gets added back to your contribution room on January 1st. So if you're already planning to make withdrawals in the early part of next year, you may want to pull that forward just a little bit and do it by December 31st. You then get that contribution room back. If you have the opportunity, you can take advantage of that contribution room next year. It just gives you more flexibility around the TFSA and around tax planning. Now, the last bonus strategy is around the first home savings account. If you're a renter, if you don't have a home and you're taking advantage of the first home savings account, you have to make those contributions by December 31st. If you want to get a tax deduction for the current tax year, then December 31st is the deadline for the first home savings account. This is different than the RRSP. The RRSP deadline is into the following year. You have up to 60 days into the following year to make the RRSP contribution, but the first home savings account is different. The deadline is the end of the calendar year. It's December 31st. So if you're a renter, even if you're in retirement, you're taking advantage of the first home savings account, make sure you get that contribution in by the December 31st deadline so that you get the deduction on your current year's tax return. Now, are there any tax planning strategies that we missed? Are you doing things to help reduce your income tax on the next tax return? Let us know in the comments. Let us know if we missed anything that we should be thinking about for December 31st. Thanks for watching. We'd love it if you like and subscribe, and we'll see you at the next one.